Greetings viewers. I, Dr. Isha Raval, Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies Technical Campus, welcome you to the series on security analysis and investment management. Today, in this session, there are two basic objectives of what we will be learning throughout this session. The first learning objective is to understand the fundamentals of financial consideration as to what are the factors which help us in determining when we take a financial decision and what is it which motivates us to take that risk. The second learning objective in this session, which we will be deliberating upon, is to describe procedures for measuring the risk of a single asset. That when you invest in a particular asset, how do you measure the quantum of risk which is involved in it? To begin with, let us understand the term financial considerations. Whenever we take an important business decision, there are two key financial considerations. The first one is the risk and the second is the return. When we talk about return is actually what you're going to get over and above what you have paid today. So your expectation by making a financial decision, that is actually your return. And the second is the risk involved. How much are you ready to forego in case something goes wrong? So each financial decision presents certain risk and return that actually determines the combination, that how you are going to decide that whether the investment which you're making will get you the desired results, and if yes, then certainly the share price or the asset which you have put your money into, the price of it will increase. But if the situation is unfavorable, there are a lot of risk factors in the market which are actually letting down the price of the investment opportunity in which you have put your investment or your money, then certainly you are going to incur loss. So whenever we make a financial decision, the two important attributes of an investment decision are risk at one hand and return on the other. Let us understand what return is. So as I just explained, return is actually the total of gain or the loss you're going to experience after you invest your money into an investment opportunity over a given period of time. So the duration of investment is clear, that when you stay invested, say for 1 year, what is it which you're getting over and above the money which you have put in, that counts your return. That return can be negative, it can be positive. So if it is positive, it is gain, and if it is negative, it is stated as loss. The second important consideration is the risk. So risk is actually a measure of the uncertainty surrounding the return that an investment will earn. Risk is the deviation from the expected or anticipated outcome and can be categorized as a volatility, variability or vulnerability of returns associated with a given asset. So when you expect the outcome to, maybe you are expecting that you're going to get a return of 10% by putting your funds in a particular asset, but on the contrary, you are not able to get that 10%. Instead, you incurred a loss of say minus 10% or you incurred a loss of 5%. There is a quantum of risk. So what sort of deviations are you experiencing by putting your funds in a particular asset? That is what we term as risk. Now, an important question arises: how do we measure this risk? If you are told that this particular asset is very risky, now how do you measure how much risky is this asset? How will I understand that this is the percentage of risk involved with a particular investment alternative? To understand that, there are different types of measures. But before we talk about those methods of estimating risk, let us understand that whenever we use the term risk, it is actually the total risk, which is the summation of your systematic risk on one hand and unsystematic risk on the other. Now, when we talk about systematic risk, this is one risk which cannot be diversified. That is why it is known as undiversifiable risk. Whereas the unsystematic risk can be diversified away. That means you can pick and choose such assets in your portfolio through which you can nullify the risk associated with all of those. See, practically it is not possible to nullify the entire quantum of risk involved in any asset. But yes, with such combinations, we can actually prepare a portfolio wherein the stocks are negatively correlated, or the assets in which we are putting our funds are negatively correlated, and then we can design such a portfolio which minimizes the quantum of risk. So as we understand that the total risk is a summation of systematic and unsystematic risk, and systematic risk cannot be diversified, let us see how can we calculate, how can we measure the diversifiable risk. So the other word for our diversifiable risk, as I just stated, is unsystematic risk. So the risk of a security is the sum of systematic and unsystematic risk, but the unsystematic risk is actually the extent of variability in the security's return due to the specific risk attached to the firm of that particular security. Now, when I say the particular security, for example, you invest in a particular security belonging to power sector. So if there is a government policy which is impacting the power sector, you can certainly diversify this risk. You can certainly go away, in fact, lessen the quantum of risk by selling that particular security and buying the stocks of some other industry belonging to some, maybe from an FMCG sector. So this is one way wherein you can diversify your risk associated with that particular security. Therefore, it can be removed from the total risk of portfolio by investing in large portfolio securities. So if you select a lot of securities belonging to different sectors, you can certainly create a portfolio with a lot of diversification. And this is possible because the specific risk factors of a particular security, of a particular industry, of a particular firm, they're very random. So one industry may be impacted due to a policy, the other may not. That is why we say that this risk, the unsystematic risk, can be diversified. Now the question arises, how do we measure it? Now, in fact, when I say the diversification, I would like to cite another example. When suppose the financial position of one company is weak, the financial health of the other in the portfolio can be strong enough to neutralize the risk attributed by the weak financial position. So a company incurring losses, the other covering up those losses and is in profits. So ultimately, when we see the overall impact in the portfolio, the loss gets nullified. Now, as I was discussing about investment risk, we actually understand that typically the investment returns, they are not known with certainty. We know this thing that if I predict a particular return of say 20% from an asset, I may not be right. There is no certainty that yes, I'm going to get this 20% of return after 1 year or 2 years if I stay invested in that particular security. And the investment risk pertains to the probability of earning a return less than what I expected. That means I expected 20%, what I'm getting, for example, maybe I'm just taking a hypothetical situation wherein I'm getting 10%. So my risk is this deviation. What I expected 20% and what I'm getting is 10%. So the greater the chance of a return far below the expected return, we say the greater is the risk associated with that particular security. Now, as you can see here in the chart, there are two stocks, stock A and stock B, which have been plotted on a graph, and we can understand, we can say through this normal distribution, we see that stock A is riskier than stock B. The reason is that the deviations. If you see the deviations are far more here in case of A than in stock B. That is why we say that whenever there is a deviation, standard deviation, in fact, I would say in this case, it measures the standalone risk of an investment. And the larger the standard deviation, the higher the probability that returns will be far below the expected return. So, if I want to conclude here that how do I measure risk, one important clue which I have given you is standard deviation. That means if I calculate my standard deviation from a particular security by understanding the variability of returns and how much the returns are spread, then I can technically estimate the risk associated with a particular security. And the square of standard deviation is known as variance. So many a times you will see that there are few portfolio analysts, there are few stock market analysts who use standard deviation as the risk measure, whereas the others, they use variance. So variance is nothing but the square of standard deviation. The other method of measuring risk is coefficient of variation. Now, coefficient of variation is an alternative measure of standalone risk. So that means coefficient of variation can again be used to measure the unsystematic risk associated with a security. Now, when I say standard deviation and variance, how do we calculate that? Actually, variance is a measure of the squared deviations from the mean and is calculated as you can see it on the screen. So if you see the calculation of variance, it is a measure of the squared deviations from the mean. So whatever is the mean, whatever is the actual return, you subtract the actual return, the mean from the actual return, square it up, and then you take the average of it. That is your variance. And so when you want to calculate the standard deviation, it is just the square root of the sample variance. So when you say you want to measure risk, technically it should be standard deviation. When you do a square of that standard deviation, what you get is the variance. So if you want to measure unsystematic risk, the two important measures here what we are discussing are number one, variance, and the second is your standard deviation. Now let us understand this with the help of an example. Here we have 4 different securities. Number one, A Limited, then Sensex represents the market. The second company which I've taken here is B Limited, and the fourth one is the Treasury bills. Because we know that Treasury bills actually bear no risk. They are considered to be risk-free investment. So let us have a look at the expected return and the risk associated with all the 4. A Limited has an expected return of 17.4%, while the risk associated with the A is 20%. Sensex, the market return has Sensex has expected return of 15% and risk of 15.3%. B Limited has 13.8% expected return while 18.3% as risk, and Treasury bills are likely to provide an expected return of 8% with 0% of risk, because Treasury bills are issued by the government and you have a security that your money will not go anywhere. So that is why we have taken the risk to be 0%. Now when you at a glance, technically when you look at this charts or these figures, you will say that out of all of these 4 options given to you, the quantum of risk is highest in case of A Limited. Why? Because it is saying that you will be bearing 20% of risk and you are getting a return of 17.4%, and you will say that A is riskier than B because B carries a risk of 18.3%, but A has 20% as the risk. Let us understand that when we are comparing risk, it is not a standalone comparison which we are doing. It needs to be understood, it needs to be compared with the help of how much return are we getting vis-a-vis the risk we are bearing. That means the return and risk usually go hand in hand. So higher the amount of risk, higher will be your expected return. Now to do this sort of comparison and to understand whether as an investor you should put your funds, you use the concept which is known as coefficient of variation. So coefficient of variation is calculated as expected return divided by the standard deviation of a particular securities. Now let us calculate the standard deviation of Treasury bills. When we do this comparison, because we are putting here, we find the coefficient of variation is actually coming out to be 0%. In case of A Limited, it is 1.1, in case of B Limited, it is 1.4, and in case of the last one, which is equal to the market, is 1. Now, when we see the coefficient of variation, and we try to relate it to the return and the risk, what do we conclude? A Limited with an expected return of 17.4% and a risk bearing capacity, the risk associated with it is 20%, my coefficient of variation comes out to be 1.1. In case of market, it is the expected return is 15, risk is 15.3. So technically when you divide it, you actually get a ratio of 1:1 or just 1.0:1. For B Limited, it is 13.8 and the risk is 18.3. So this is very, very high. If you look at all of these measures, 1.4 is the highest coefficient of variation in case of B Limited, while for treasury bills, as I just stated, the risk is 0%. So which gives you a coefficient of variation as 0, which will be 0 divided by 8. So in the first case, it is 20 divided by 17.4. In market, 15.3 divided by 15. In B Limited, it's 18.3 divided by 13.8. And in treasury bills, it is 0 divided by 8. So anything divided by 0, as I just stated, risk will always be null in case of treasury bills, in case of government securities, in case of any such asset where there is a surety, there is a guarantee that your money will come back to you. So your post office investments, even for that matter, will have a 0 risk. Now, a lot of people say that market risk should also be 0. Why do we say that market risk is there? Because when you're putting your funds in market or maybe in Sensex or in Nifty, they are the indices. So when you invest, you actually are bearing a risk because this Sensex or this market actually represents a wide variety of stocks and they are actually a portfolio. So when we talk about Sensex, it is a portfolio consisting of 30 stocks. When we talk about Nifty, it's a portfolio of 50 stocks. So that is that the market risk there is definitely there, because that is why whenever we see the variation in the markets, whenever we say that the market is very choppy, or we say that the market is bullish or the market is bearish, what are we indicating? We are telling about the expectations we are having, the returns the expectations from the market, the Sensex, the Nifty, plus we are also comparing it with the risk. So here, in most of the times, whenever you come across with a question, you will usually find that the coefficient of variation in case of market, in case of indices, in case of Sensex or Nifty, it will always be 1. Because the returns expectations and most of the times are in tandem with the risk. But the stocks which are specific to a particular industry, the stocks which are particular to a specific sector, there in that case the coefficient of variation may be rising, it may be falling. It can be more than 1, it can be lesser than 1 as well. So it is all dependent on the market situations and how is the stock correlated with the market. How is it performing in relation to the market? Now, when we analyze this, that in case of A Limited, the coefficient of variation is 1.1. For market, it is 1. For B Limited, it is 1.4. And for treasury bills, it is 0. So as a novice, if you are told that these are the values which I am getting for coefficient of variation, now which stock will you choose? Now, when you consider just the return, you may say that I'll choose A Limited. But when you look at the risk, you will be, or you'll actually get shattered that, oh my God, that A Limited has a risk of 20%. Should I go for it or not? Rather, the highest paying is market. So let me stay invested in the market where the risk is just 15.3%, which is very much less than A Limited. And in case of B Limited, it is the return is less and the risk is pretty high. So when you are comparing, you are given a choice between probably A and B. You may select A or you may select B. When you look only at risk, you will definitely say B is less riskier. Let me go in for B. What when you look at A, you say that no, you compare it on the basis of returns. You may say that, okay, let me go in ahead with 17.4%, that's A Limited, whereas B Limited is 13.8. Now to the underlining point is here that when we are comparing, when we are trying to identify which measure is going to give me the correct answer to this, risk you've already measured through standard deviation. So technically, you may select after looking at the standard deviation values of A and B, you may land up selecting B. But when you go a step ahead and do the analysis of the expected return and the risk, you calculate that when we talk about B, the coefficient of variation is much higher than A Limited. So as an investor, if you are a risk-averse investor, or if you are not in favor of taking a lot of risk and you're not a risk lover, you will opt for A limited on the basis of coefficient of variation, which is technically the right choice. But if you are a risk lover, you are okay with taking risk, you may say that okay, it's fine, 1.4 is also okay with me because it is likely to give me return. But you actually need to compare how much risk and how much return. The greater the quantum of return, your likelihood or the benefits which you are going to reap would go down. So on the basis of coefficient of variation, which is a very, very important measure of risk, when you do this comparison, you will certainly opt for A limited and not for B limited. Now let us put this here on the graph. Now this is a graph which compares the return and the risk. Now risk here is measured in terms of standard deviation and is represented in percentage, and return is also percent return. Now, as a novice investor, if you are given this graph, which investment is the best? Now here what we have done is we have plotted the same table on the graph, comparing it with return and the risk. We go back to the previous slide here. A limited has 17.4% and risk is 20%. So as you can see here on the graph, A limited, we have selected return and the risk, and we have plotted it. Going to the second one, the market is 15 and 15.3. The same has been represented here. The third one, B limited, return 13.8, risk 18.3. The same has been plotted here, and treasury bills 8% return and risk is 0. As you can see that when the risk is 0, we have plotted the treasury bills to return at 8%. Now looking at this scenario again, when we are trying to compare the return and the risk, we select stock A, which gives us a coefficient of variation as 1.1. Now, coefficient of variation is actually doing an understanding how is the return responding in terms of risk, because nobody would ever like to take more risk and expect less return. As an investor, we always say, or we keep hearing, that higher the return, higher the risk, higher the return, and vice versa. But that may not be true, as we've just witnessed in case of security A limited. Though the risk is 20%, the return is 17.4, and in B, the return is 13.8, which is though less than the expected return of A. But when we do the comparison, when we actually do the cost and benefit analysis, it's a very important term which is used in economics these days, that whenever we do the cost benefit analysis, we are able to make the right decision. So here, when we are doing this sort of analysis, it is pertinent for us to do the comparison between expected return and the risk. So the best option available to us is not just standard deviation, not just variance. Instead, we need to go a step further, and we must calculate the coefficient of variation. So when we do the expected return, that return, here in this example, we talked about expected return, but the return can actually be a historical return, the return which has already taken place. So you may get a question on the historical return, and you may be given the question on expected return. So historical return is the return which has already happened. You invested in a stock, stayed invested for 1 year, and then you did the calculations and you found out that this is the actual return which has accrued to you. Whereas expected. So whenever we invest in a particular stock, whenever we put our funds in a particular asset, we always do it with an expectation, considering there can be boom, there can be recession, there can be moderate times, there can be average return. So the calculation of this expected return is very important, because the entire decision of whether to invest or not will be dependent on your expectations. So the probabilities which you assign to the boom period, the probabilities you assign to the recession period should be done wisely. On the other hand, the risk calculation which you do on this, which method, what technique will you use for calculation of risk, is again very important. Can be standard deviation, can be variance, but the best is you compare the expected return with the risk, and you use the term what I just discussed, that is coefficient of variation. When you do this, you're able to take a better decision, a sound decision. Thank you so much. Happy learning.